Okay, let's dive right into this explainer. Today, we're unpacking the heavy, compliance-driven year-end accounting processes that keep financial statements strictly grounded in reality. I know, year-end accounting sounds a bit dry, right? But believe me, it is absolutely packed with high stakes, strict legal accountability, and literally massive financial implications. It's this intricate dance of financial disclosures. Basically, it's the exact moment where theory meets physical reality. Every single dollar recorded on a spreadsheet, yeah, it has to be hunted down and proven to actually exist.
So think about this for a second. What actually happens when a company's financial records are haunted? I really want to hook you with this concept because there is a dangerous, very real disconnect that can happen between what a company thinks it owns on paper and what actually exists in physical reality. Imagine a balance sheet proudly displaying millions of dollars in manufacturing equipment. But you walk the factory floor and that equipment was actually scrapped 6 months ago. That disconnect? It's not just a minor oops moment. It's a fundamental failure of financial reporting that can completely mislead investors and trigger some serious regulatory consequences.
To fix this, we're essentially playing detective, hunting for two very specific anomalies. First up, we've got ghosts. A ghost asset is something that lives on the fixed asset register, inflating the books, depreciating away, making the company look super asset-rich, but it doesn't physically exist anymore. It's a total phantom. Then we have the exact opposite problem, the unregistered asset. This is a piece of equipment that physically exists, it's in active use by the team, but it is completely missing from the fixed asset register. Honestly, both of these are massive red flags, because both mean the financial reality being presented to the world is just flat out wrong.
So here's our chronological roadmap for this explainer. First, we'll look at the reality check. Second, the big tie-out. Third, disclosures and SOX audits. And finally, managing asset risks.
All right, jumping into part 1, the reality check. Specifically, stage 27, physical and intangible verification.
This verification stage is the ultimate non-negotiable reality check. When we talk about verifying property, plant, and equipment, or PP&E, we aren't just taking someone's word for it. No way. Independent teams have to physically verify every single asset against the fixed asset register, and they are checking 4 strict criteria. Number 1, location. Is the asset physically sitting exactly where the register says it is? 2, condition. Does the real-world condition actually match what's recorded? 3, use. Is the asset truly in active use or is it just gathering dust in a dark corner? And 4, ownership. Does the company still legally own the thing? Finding these physical assets and checking off these 4 boxes isn't just about having an organized warehouse. It is a strict Sarbanes-Oxley, or SOX, Section 404 key control. That means it requires hard, documented evidence. You literally have to prove you looked and prove exactly what you found.
But, well, what happens when you can't actually touch the asset? Let's shift gears to intangibles. Because we can't physically slap a barcode on a patent or a customer relationship. We have to meticulously interrogate the intangible asset register. This requires a really rigorous annual review. We're hunting for lapsed legal protections, think expired patents, or a trademark that nobody bothered to renew. We're looking for retired software, or maybe abandoned customer relationships that just aren't in use anymore. We also have to reassess useful life, just to see if an asset's finite or indefinite classification needs a tweak. Plus, we check the status of in-process R&D to verify if projects have been wrapped up or just totally abandoned, and review goodwill reporting units for any structural business changes. It's a completely different kind of verification for sure, but it's equally vital.
Just to briefly round out this whole reality check phase, we also have to look at prepaid expenses. These guys undergo strict monthly reconciliations, where the prepaid schedule is compared directly to the general ledger. And that's all capped off by a comprehensive annual expiry review, just to confirm that all service periods are actually still active. Before any period can definitively close, the physical assets, the intangibles, and the prepaids, they all have to be fully verified. The whole shebang. Moving right along to part 2, the big tie-out. This is stage 28, period close reconciliations. Okay, this is where the tension within an accounting department really hits its peak. Why? Because all that physical reality we just talked about must now perfectly match the books across 4 massive reconciliations. The fixed asset register, the intangible asset register, goodwill, and active prepaids must all tie out to the general ledger flawlessly. If even a single one of these is slightly out of balance, the financials simply cannot be finalized. It's a total roadblock.
Now, I really want to highlight why reconciling the intangible asset register is so perilous.
Unlike standard depreciation of physical equipment, which, is usually highly automated by accounting software, amortization on intangibles is often posted as a manual entry. And let's be real, anytime human hands are manually entering numbers month after month, the risk of error absolutely skyrockets. These manual amortization entries are essentially perfect hiding spots for potentially disastrous financial misstatements. If someone just fat fingers a number or completely forgets an entry, it might go unnoticed. That makes the intangible asset register versus general ledger reconciliation an absolutely critical control point. We have to catch those undetected errors before they go public.
Which brings us to what I like to call our zombie problem. A zombie asset is an asset that is fully amortized or depreciated on paper, meaning its book value is literally zero and the system thinks it's dead, but it is still alive, still in active use, and still working hard in the business. Just like a fully depreciated machine still chugging along on the factory floor, a fully amortized intangible still generating value demands an annual reassessment. You have to step back and ask, do we need to extend its useful life? We absolutely cannot have invisible assets driving revenue without proper tracking.
All right, let's head into Part 3, Disclosures and SOX Audits, Stage 31, Going Public.
So, this is the following action of our process. It's where we take all this meticulously verified data and present it to the SEC, the PCAOB auditors, and of course, the public. Under US GAAP and the SEC, there is a very stringent requirement regarding intangible assets. Companies are legally required to disclose the estimated amortization expense for each of the next 5 years. Yup, 5 years. You can't just report the past. You have to project the financial impact of your intangibles half a decade into the future. It's crucial because it gives investors a crystal clear sightline into future expenses that will drag on earnings down the road.
And listen, if things haven't gone according to plan, the disclosures get much, much heavier. If a company has to recognize goodwill impairment, which basically means an acquisition they made just isn't worth what they originally thought it was, they must adhere to strict disclosure rules in the Management's Discussion and Analysis, or MD&A. They can't just sweep a loss under the rug. They must explicitly detail the reportable segment affected, the exact amount of the impairment, the specific circumstances that led to the loss in value, and exactly how the new fair value was determined. This means completely pulling back the curtain on their critical accounting estimates. They have to show their methodology, their significant assumptions, and reveal the sensitivity of their discount and growth rates. It is full, unvarnished transparency into a financial loss.
Let's look at how all this builds into the broader compliance ecosystem, because the internal stakes versus the external ones are fascinating. On the internal side, under SOX 302 and 906, the CEO and CFO are literally putting their necks on the line. They must personally sign off and legally certify the effectiveness of their internal controls over things like capitalizations, amortizations, impairments, and disposals. If they lie or even just fail to maintain those controls, there is real personal legal liability. On the flip side, you have the external check, the PCAOB integrated audit. External auditors come in and rigorously test those same exact processes. They're testing capitalization criteria, checking the accuracy of the math on amortization, and auditing the adequacy of the impairment process. It's a massive dual-layered system totally designed to ensure the numbers presented to the market are absolutely bulletproof.
Which brings us to our final section, Part 4, Managing Asset Risks, Tracking KPIs, and Avoiding Failures.
To ensure disastrous mistakes aren't just repeated at year-end, finance teams have to track these processes year-round. Remember those ghosts we talked about at the very beginning? Well, an unauthorized or unrecorded disposal leads straight to ghost assets haunting the register. This causes overstated assets on the balance sheet and results in an outright SOX internal control failure. Bad news. Similarly, if the intangible asset register isn't maintained, it leads to those undetected amortization errors. To combat these risks, healthy organizations use vital lifelines in the form of key performance indicators, or KPIs. They track the number of IAR versus general ledger reconciliation exceptions every single month. They don't wait for year-end to find out things are a mess. They also meticulously track their SOX control exception rate per cycle. Consistently monitoring these KPIs is really how a company ensures its processes stay squeaky clean all year long.
I want to leave you with a thought that brings all of this theory right back down to the real world. If external auditors walked into your company's facilities right now, today, with your fixed asset register in hand, how many ghosts would they find? Seriously, how many missing computers, scrapped machines, or abandoned software projects are secretly inflating your books right now? Year-end accounting isn't just about balancing spreadsheets. It is a relentless, ongoing hunt for the truth. Keep that in mind the next time you see a highly polished financial statement. Thanks for joining me on this explainer, and as always, keep questioning the numbers.